Hello and welcome to Credit Versio's Q&A Wednesday live for June 30th. I'm your host, David Michalek. Every Wednesday we stream live to both our Facebook and YouTube channels at 6 p.m. Eastern Time to talk about one of the most important things to talk about, and that's credit. And we're here to also to answer your questions. So please take a second, introduce yourself, let me know where you're from. And if this is your first time joining us, please let me know. Happy to have you here. Every week we send out an invitation email to every new Credit Versio subscriber, and that results in usually hundreds and hundreds of people. So if you've decided to join us today, thank you so much for being here. And as I'm sure you know, our credit report and scores play a substantial role in so many areas of our lives. When we have employers, insurance companies, landlord, mortgage brokers, banks, and that's just to name a few, looking at our credit reports to see how we honor our obligations, you can see why credit reports are so important, and so is that credit score. Having great credit is mandatory because credit reports have become a lot more than just a credit report. They become our adult report cards, and they tell the story of what we do when we are entrusted with credit. Do we honor our word or do we not honor our word? And of course, sometimes things happen. That's why a lot of people come to a service like Credit Versio to do a little repair and also to learn about credit. And that's why we do these weekly broadcasts. And back with me today, I'm happy to say that we've got America's #1 credit expert, John Ulzheimer. I'm going to play a quick intro video for John, and then we're going to get right to it. Here we go.
John Ulzheimer is America's most recognized credit expert. With 30 years of experience in the credit industry, having worked for both FICO and Equifax, he's the go-to authority for answers to credit questions. Here to answer your credit questions, Credit Versio presents John Ulzheimer.
John, welcome.
Thank you for having me, David. I love our little Wednesday evenings together.
I'm so impressed that that even though we only got, because John and I had a seminar this month called Credit Con that was in Florida, so it threw off our normal schedule. So we were together last Wednesday, excuse me. And then John is good enough to take a little time out from his little beach vacation to hold up his iPad and do our usual Q&A Wednesday. So John, that's awesome. Thank you so much. And speaking of Florida, we got somebody from Florida here, Pasale. I hope I'm saying that right. I might be butchering that, but welcome. And so, John, I just saw a recent video that you did that I thought was fantastic. And the purpose of this video, this Facebook Live, is for people to ask whatever questions that they like. Of course, really the purpose of this Q&A Live is to talk about credit, answer your credit questions. If you're doing some repair using Credit Versio, or you're just here to learn from John, then fire away whatever questions you've got, and we will be happy to answer them. And John, one of the things that you did a video on recently that I saw that I thought, wow, this is absolutely excellent. This is a really important topic because I know that a lot of people who are either going through the repair process or they're right now maybe just saying no to credit for whatever reason. Maybe they went through a bad time. They're not rebuilding. Those people are using debit cards, and debit cards come with a tremendous amount of risk. And you did a fantastic video comparing debit cards to credit cards. Hello, David from New York. Welcome. Thanks for joining us. So I thought while we're getting people asking questions, we can start with going over some of the differences between the debit card and the credit card, the pros and cons. And if you wouldn't mind stepping us through this, that would be fantastic. Now, I made a nice little cheat sheet for us, so I wouldn't force you to remember what you did on a grease board weeks ago, maybe a month ago or so. And well, when I see the volume of material you put out, it's like, I know I don't remember some of the stuff that I do from 1 week to the next, so I thought this would be a lot easier. Okay, why don't we just pop this little screen up, and hope everybody can see that. It's debit card versus credit card. And John, you broke this down into 5 subjects: fraud protection, credit building, capacity, usability, and control. And if you would, why don't you start with fraud protection, debit card versus credit card?
Sure. And you can even, David, you could even throw in prepaid debit along with debit, and we can use prepaid debit as part of the comparison, even though it's not on the chart. And the reason this is an important topic, well, there's two reasons. Number one is there's so much misinformation about the kind of the attributes of credit cards versus the attributes of other forms of plastic,
Mm-hmm.
and other forms of payment. And so that's why I actually do some videos and some writing about these, kind of comparing the attributes of the two types, and then kind of showing the kind of juxtaposing them to one another. And another reason I do it is because credit cards are roundly vilified by consumer advocates, and I think
Yeah.
very, very unfairly.
Yeah.
And so that's another reason why I try to point out the differences between credit and debit. So obviously, a credit card is in fact an extension of credit. You have to apply for it. It has to be approved. It has to be issued. It is tied to a line of credit that's generally referred to as a credit limit, and that is the upper boundary, your spending power, if you will, for that card. And you're using the bank's money, and they are agreeing to let you use it if you are willing to follow certain terms of use. And obviously, I think probably everybody watching has credit cards and will have more credit cards as they go through their consumer credit life cycle arc.
Yeah.
Debit cards really are nothing more than a plastic check. So they're tied to some form of a deposit account, many times a checking account, and they're really no different than the old-fashioned paper checks that us old people used to write, many years ago.
Yeah.
And the money is pulled directly out of our checking account. And one of the primary differences is, one, with a credit card, you're using the bank's money. When you're using a debit card, you're using your own money. And if you want to throw prepaid debit in there, prepaid debit is really neither. You're actually it's really nothing more than what's called a stored value card, where you're giving money to some entity and they're turning around and they're cranking out a card that has that amount of money. Think of it really like a glorified gift card that you'd buy at the mall.
Yeah.
Give,
That's a great
give
way to
them
play it.
for sort of a gift. So that's really kind of the difference between the three methods of payment. One is in fact an extension of credit, where the other two are not extensions of credit.
Excellent. And as far as going off of number one, the fraud protection, maybe you can cover the difference between the two. Meanwhile, we got Mike Smothers. Mike was good enough to send a chat, or a direct message rather, saying that he's taken a new, I guess, hours at your work, Mike, but our regular attendee just dropped in to say hello. So good to see you, Mike.
Yep, welcome. Mike's a regular. So when it comes to fraud protections, credit cards are, I think everybody who's had a credit card probably has had some form of an experience with some thief or fraudster getting their hands on your credit card information and has used your fraudulently. And credit card issuers had to close your account and send you a new card, et cetera, et cetera. And it's kind of inconvenient. But you haven't had to pay any money. That's the one thing that we can all say that we do have in common, is that if we were the victims of credit card fraud, none of us had to pay any money, and here's why. Number one, the Fair Credit Billing Act, which is not the same as the Fair Credit Reporting Act. It's a different federal statute. So the Fair Credit Billing Act, or the FCBA, is the federal statute that, among other things, caps your liability for credit card fraud to no more than $50, assuming that you report it. You can't just not report it, of course. Even on top of the $50 cap from the FCBA, the four major credit card networks, Amex, Discover, Visa, and MasterCard, all have zero fraud liability policies. Zero. So even though the law allows them to hold you liable for the first $50 of the fraud, the four major credit card networks are like, you know what? We're going to hold you liable for none of it. So unless you just have never reported the fact that you've been the victim of credit fraud, you've never had to pay a dime, which is something that here, all these data breaches, the Target data breach, the Equifax data breach, the MyFitness, you can go on and on and on about data breach, one data breach, where some form of method of payment was exfiltrated or stolen by a fraudster. While that's inconvenient, none of us have ever had to pay a dime out of our own pocket when that's
Yeah.
happened because of the DA. Another thing to really keep in mind, and this is important when I jump back over and compare it to debit card, is that all the money that's being stolen off of your credit card belongs to a bank. It's not your money, it's the bank's
Right.
money. Now let's talk about debit cards. The FCBA does not protect you from debit card fraud. That's the EFT, the Electronic Funds Transfer Act, or the EFTA. The Electronic Funds Transfer Act also caps your liability for fraud for debit cards, but there are some scenarios where if you don't report it fast enough, the cap on liability is $500. So
Yeah.
it's a
Big difference.
big difference, a larger cap on liability, and maybe even more important is this is your money that has been stolen, not a bank's money. So it's a very different sense of urgency when your
Right.
money is being out of your account versus some bank's money is being siphoned out of your credit card account. You're not going to get your money back immediately, which means that there may not be enough fundage in
Mm-hmm.
your account to cover other reoccurring bills that are paid out of that particular account. So it's a very different level of stress. It's a very different level of problem when you
Right.
compare the of a credit card versus the fraud protections and the fraud experience, if you will, of the
Yeah.
debit card. I had to compare the two and kind of assign a higher grade to one of the two. I would always assign the fraud protection higher grade to the credit card versus the
Sure.
debit. Of course, if someone steals your prepaid debit card, that money's gone. You're not going to get any of it back because essentially it's already been spent to buy
Right.
the card. It's already been
Yeah.
loaded on the card, and the fact that it's being used, there's really no one to call to prevent that from happening, which puts them really at the bottom of the list in my mind.
Yeah, I think the example that you gave, that it's like a glorified gift card, is a perfect example. The money's already there; it's spent. There's nothing that you can do
Yep.
if that card is gone. And also, too, one of the things that could be a big concern, and why I wanted to bring this up today, knowing that a lot of people use debit cards, even though I have 3, 4 credit cards, I do on occasion catch myself like, oh shoot, I'm going to use my debit card at the grocery store, remembering that what is the cost if something goes wrong? Well, all my expenses are paid out of that account. If somebody wiped that out, it would be, not everybody's got money to move from one account, from a savings account into a checking account to cover rent. So it's a good point. Okay, why don't we take a quick pause here, and we got a couple of questions. I hope I'm not Pasale. I'm so confused about the pay by statement date. My utilization is high. Okay, that's a really, really good question.
Yep. It's the ethical credit score hack. I think we've called it that in the
Yep.
past. So this is actually very simple. So when you get a bill, I assume that you get it online or that you get some sort of a notification that your statement is ready and you just log in and you can view it. Or, you may be old school and you may get a statement in the mailed to you. That statement is generated the same day every single month, and it's called your statement closing date. And that's basically the end of the 30-day period where the credit card issuer will look at all the activity during that 30-day period, and that's what your statement is based on. So charges, payments, credits, fees, returns, anything like that occurs during that 30-day period, the net of that is going to equal your statement balance and any amount that you rolled over from the prior month, if there is any. That's what your statement balance is made of. That's also the balance, and this is the important thing, that's also the balance that's reported to the credit reporting agencies. So even if you pay your bill in full every single month, the fact that you have a bill causes your credit report to have a balance greater than zero. And even if you pay it on time, which is fantastic and you should do, even if you pay it in full and on time, the fact that you're continuing to use your card and the usage overlaps with the grace period, that means next month you're going to get a statement with a balance on it, and you're going to perpetually have some form of a balance showing up on your credit report. So the way around that, because most people, when they pay a credit card bill, they target the due date, which is 21 days statement closing date. So the strategy here, this ethical credit score hack, is to pay your bill before it is actually generated. So you can go online and make a payment on your credit card bill right now, even if you don't have a bill due or a statement waiting with a due date. And if you can let's say that your balance is $5,000 right now, even before your statement has been sent to you. If you go make a payment of $5,000, your statement is going to have a zero balance, which means that what the credit card issuer reports to the credit reporting agencies is going to be 0, which is really good for that utilization ratio. Yes, you are giving 21-day grace period, but the fact that you are going to pay it in full anyways, perhaps you don't really even need the 21-day grace period. So that's really the strategy, is you're really just focusing on the statement closing date as the kind of metaphorical due date versus the actual due date, which is 21 days after your statement has been sent to you.
Yeah. And also to Pascale, if I'm saying that correct, and also Melissa, who made the comment that I just put up about this being a great tip. One of the things that I do, just to give you a little insight from the lesson, this lesson that I learned, is that on my cell phone, on my calendar, I have the end statement dates for all 4 of my credit cards. I know exactly when that statement date is going to end. And because I pay all of my bills online, I just log on. I tried showing this last week, but I don't think it came through because of the way I have my focus set. But just right along the top of my smartphone is my bank and all of my credit card apps, which, by the way, I check probably every other day. I'm a little compulsive with it. But when that statement date, let's just say, for example, my Chase card, I believe, is on the 21st. I pay that card in full on the 18th. So I know that it takes about 24 hours for that payment to post. I give it about 48 just to be safe. And that's how I always keep my utilization rate either at 0 or, unless I bought something big, but usually all of my cards are paid off.
Yeah, and it's not something that you have to do every single month. It's not like a requirement. But if you're about to go apply for a mortgage or a car loan and you need the absolute highest credit score possible, you don't have to stop using your credit card for 2 months for it to show up as a 0 balance on your credit report. You can continue to use your credit card like you normally use your credit card, just for the 1 month prior to going and applying for something. Pay it by the statement closing date instead of paying it by the due date, which means that when your lender pulls your credit report, your credit card balances are going to be at or near 0, and that utilization ratio is going to be low, and you're going to be able to juice every point out of the credit score possible, get the best deal on whatever it is that you're applying for. And then next month, if you want to go back to paying by the due date versus the statement closing date, no harm, no foul. That's it. So that's what I try to tell people, is here's this option that you have available to you, that you don't have to do it every single month. But if you want to get as many basis points off that loan as possible, that's not a bad idea.
Yeah. Well, like I said, I'm probably on the extreme. I just don't like seeing balances at all. So I take it to another level. Okay, Scott Oliver. I ran up my balances on 2 cards last month, more than normal. Score dropped like a rock, 42 points. It's actually not too bad for really raising your balances. I paid both off a month later, and the score goes up about 10. Hardly seems fair, doesn't it?
Yeah. So.
Whoop. There we go.
I got it. So. Like I said, just because you paid them off doesn't mean that there shows a 0 balance on your credit report. So, and we don't know for sure if all 42 points were because your utilization spiked, and we don't know that. So there's a whole lot of unknowns in that comparison. But to the extent you can get that ratio as low as possible, that's you're gonna kind of claw back as many of those score points as you possibly can.
And David with a comment, I always pay my balance down to 1% on my due date to let it report on the same statement date. Very good. Well, you can do 1%. I mean, I know, John, last time I think we had a pretty deep conversation about chasing the magical 850, where 1% utilization was really the key factor there. But if you're not close to an 850, then does that 1% really matter much?
Yeah, I mean, if you're at a rate tier threshold and you need every possible point, and you're just a few points shy, that may be a good strategy. I mean, to me, that's a very dangerous strategy, because what if 1% is aggregate, which means that it's all of your balances combined, 1% of your aggregate limits. So some people will hit 1% across multiple credit cards, and then they end up penalizing themselves because of too many accounts with balances, and they actually the net the net of their actions is actually negative rather than helpful. So I don't like that as a month after month strategy. I actually like the pay in full strategy a whole lot better because it's a whole lot easier than trying to constantly calculate 1%
Yeah.
credit card relative to the limits on all of your credit cards.
Yeah.
Like, wait,
Yeah.
can I fill up my car today, or is that going to put me at 2%? It's just like unnecessary constant math.
Right. Right. Okay. So that's it for the questions. We're getting through them pretty well today. Okay. So for fraud protection, I think that goes to the credit card. Would you agree? And then for credit building,
Yeah.
we talk a
So
bit about credit building.
yeah. So this is the one where there's a lot of misinformation floating around in the world. Um, you do not get any credit building value out of debit cards or prepaid debit cards. And I bring that up because a very, very famous self-proclaimed credit expert used to go on TV all the time and talk about how debit cards will help you build credit and
Yeah.
they're better credit score, blah, blah, blah. And that is factually inaccurate. Um, your checking account is not on your credit report, right? Have any of you ever seen your checking account on your credit report? No. Why? Because they're not an extension of credit. And your debit card is really nothing more than a plastic version of your old-fashioned paper checking account. So you get no value out of your debit card versus your credit card, where obviously if you abuse a credit card, it can be harmful to your score. But at the very it is the more it is the viable option of the two as it pertains to credit building. And of course, prepaid debit. I mean, none of the gift cards that you bought for any of your friends at Christmas or that you received for your birthday are on your credit report or on anybody's credit report because they're credit. So the credit building is absolutely something that's in there. And even in the credit reporting industry's standards manual, the Metro 2 manual, there's even language. That's one of the FAQs for lenders is, can we report our debit card accounts? And the answer is no, they're not extensions of credit. It's almost a little bit comical to see how parental the answer is. No, you can't do that. That's wrong.
Yeah.
Almost like what a parent would tell their young child when they're trying to teach them a lesson. Even then, they should know better because I think everybody acknowledges that checking accounts are not extensions of credit.
That's a no-brainer, except for the unnamed person who goes on TV and says that debit cards will help you build your credit.
Yep.
That's kind of in the same vein when you were telling me. I don't know if you were in some congressional meeting. I don't remember the specifics where there were elected officials standing up, crying about how the whole credit reporting needs to be redone because people can't get jobs because employers won't hire them because of their credit score. And
right.
Of course,
I sat through and watched members of the House of Representatives get up and essentially verbally abuse the guy who was the president of the Credit Reporting Industries Trade Association at the time, and basically make fools of themselves by saying that my constituents cannot get jobs because of their credit scores being so low, which is false because employers don't even have access to credit scores. And I was sitting in the back, shaking my head like, man, I can't believe that I'm listening to this mumbo jumbo. And these are the people that want to take over the credit reporting system, by the way.
Oh yeah, that's starting to heat up a little bit too. And I have a hard time reading through those articles. It's like it's not the reporting agencies, but we'll have to see how that unfolds.
It's stuff to talk about.
Yeah. Okay, so credit building, we'll give that one to credit cards and capacity. Let's talk about capacity.
Yeah, so capacity is a big one. Credit cards are plastic. It's plastic capacity, buying power, right? $5,000, $10,000, $15,000, $20,000, $30,000, $40,000 of buying power in the form of a piece of plastic or a piece of metal. And it's a whole, obviously, I don't think a lot of retailers like to accept cash any longer for two reasons. A, COVID, they don't want to touch that stuff. And B, I tell you what, though, if you've ever seen any of the specials about like the cocaine cowboys out of Miami, I think at one time, like 95% of all bills circulating through the U.S. had cocaine residue on them. So cash was disgusting long before COVID-19 became. So I don't think retailers like touching that stuff. First off, and number two,
Yeah.
we've kind of converted to the era of electronic payments, and that's I think where we're headed. So obviously, usability or excuse me, capacity and buying power is, no one writes checks for $15,000-$20,000 any longer. At
Yeah.
least not a common. It's not a common thing that they do. But people have absolutely no problem spending thousands of dollars on credit cards throughout the month because of the capacity benefits. Remember, it's the bank's money, so and especially if you've got a gigantic credit card issuer, giving a $20,000 or $30,000 credit limit is a rounding error to them versus a debit card, where if you needed that amount of buying power, you'd have to have that balance in a checking account. That is not a, and financial advisors will tell you, and I'm not a financial advisor, but I will tell you that financial advisors will tell you that you do not want that amount of money in a checking account because it's basically earning nothing in interest, and that money is better parked elsewhere where it can earn more than point whatever in interest annually. So from a capacity perspective, the credit card has to be the winner there as well.
Excellent. Okay. Let's see. Let me here. Go. All right, so let's see. We have
John.
Oh,
wow! Thank you.
I'm gonna give you another intro.
The mid-call intro.
There we go. So we got capacity, usability. Let's talk about usability.
Yeah. Okay. So here's a good one. So, when's the last time any of you tried to use your debit card to rent a car or book a hotel room? Or use it for business travel. It is a royal pain in the butt, and the reason it's a pain in the butt is because and gas stations do this as well. They will actually put a hold against the monies in your account that exceeds your purchase until and it won't clear for several days. And if you rent a car, it won't clear until you've actually turned the car back in. So what happens is even though you're thinking, hey, this is only costing me $75 a day to rent this car, they're actually charging you at least twice that and hold against that amount of money, just so when you bring the car back, they've actually kind of secured any damages or any usage of the car. But the practical impact of that, David, is that if you have that money in your checking account, it's now on hold and it cannot be spent by you while it is on hold, which means that if you think that it's there to clear other transactions like bills that you may be needing to pay, it's not there. It's there, but it's kind of not there because it's on hold. That's a non-issue for credit cards, because if you have a card with a $10,000, $15,000, $20,000 limit, then who cares? It's so they put a hold against an amount of money that really doesn't chew up very much of your limit. You don't really have any usability issues if you want to go use that card to pay for other things. And so the next time any of you check into a hotel or rent a car, what I would like for you to do while you're going through the process, because they're going to ask you for your ID and they're going to ask you for your method of payment, I want you to look around the top of the counter, because inevitably they're going to have a sign or a placard or something posted that tells you, hey, we're going to put a hold, for those of you using debit cards, we're going to put a hold against your account that's in excess of what you're going to be spending with us. And those are not going to be available to you. So they actually will warn their customers that using a debit card is not the best idea. They don't give the same type of warning for people who are using credit cards, because you don't have that usability.
Right. Exactly. Okay, we've got a couple of questions here. Let's see. Oh, Melissa's got a nice comment. Credit Versio has helped me improve my credit tremendously. I've learned so many great tips, including paying the card down prior to the statement date. And thanks to this, my 19-year-old son has FICO scores above 760. Wow, higher than yours? Keep our usage below 30% across the board. Melissa, that is great to hear. Congratulations. Really good news.
Yeah, that's going to pay dividends for so long, especially for your son who's just starting out. He's I kind of call that good driver's education. You teach him how to drive, dividends for the next 60 years. You teach them how to use credit well, and it's going to pay dividends for just as long. So that's really cool to hear.
Yeah, excellent. David had a question. What are simple strategies to obtain a high limit credit cards?
Well, it's not really a strategy-based thing. I mean, in order to qualify for a high limit credit card, two things have to be true. Number one is you have to have really good credit scores. They're not going to give $30,000 limits to people with FICO 580. And number two is credit cards well, not now, for the last 11 or 12 years, have been required to verify your ability to make a payment. So they have to essentially validate your capacity. They can't just take your word for it that you're making, $500,000 a year. They have to have reasonable steps in place to verify that you have the ability to make payments. And so for people who have incomes that are higher, obviously, when you combine that with a really good credit score, then you are going to find that you're going to have a higher limit. One thing to keep in mind also, if you're looking for a really high limit, and I don't know what you define as a high limit card. Some people would say $10,000 is a high limit card. Some people would say a $30,000 limit is a high limit card. So I don't know what you're defining as high limit, but I will say this. You are more likely to get a really high limit from one of the mega banks than you are from a credit union. And the reason is because, Citibank taking a $50,000 loss is almost irrelevant to them. A local credit union taking a $50,000 loss is going to cause people to lose their jobs. And so that's why you don't typically see those really, really high limits issued on credit cards that are issued by credit unions, because of that. They have less of an appetite for large losses versus a bank where that's not even a speed bump to them. So if, from a strategy perspective, if you've already got the income and you've already got the good credit, I would tilt my shopping towards the really, really big card issuers if you want one of those really high limits.
That's a really good answer. David, I hope that helps you. Melissa with a follow-up question to that one. Do credit card companies verify income?
Not, when you say verify, when I hear the word verify, I think of what happens when you're applying for a mortgage loan, where they want copies of your paychecks and they want your tax returns, and they really are verifying how much money you make as best as they possibly can. Card issuers typically don't go to that level of verification. That, believe it or not, there are actually scoring systems, not the FICO credit scoring systems that we talk about all the time, but there are actually scoring systems that are used to predictive analytics to look at your data, your credit report data, and predict your capacity or ability to make payments. And that's really all they're required to do. They're not required to verify exactly how much money you make, because, we're in what? It's the end of June, so tomorrow is July 1st. How much money are you going to make this year? The year is half over. How much money are you going to make this year? And I would suspect that a lot of people watching, if not everybody, is like, I don't know. I mean, this is my salary, but I might get a bonus. I might get an increase. If I'm an hourly worker, I might pick up hours. I may drop back hours. I may sell a piece of property. There's a lot of things. I may get a new job. I may get a second job. There's a lot of things, a lot of moving parts as it pertains to your income. I have no idea how much I'm going to make until the year, and then I can look back and say, oh, that's how much I made last year. So it's really hard to verify income, because even the consumer in many scenarios don't really know how much money they're going to make, because there's so many moving parts. So really all that they're required to do is verify that you have the ability to make a payment or the capacity to make a payment. And then from that point, that's really where their obligations cease, versus installment lenders, which are typically the ones that are loaning larger dollar amounts, because that's usually things like homes, second home, or transportation, like vehicles and RVs and such, where they really do want to see how much money you're making, at least as best as possible, because your monthly payment is likely going to be much higher for a longer period of time.
Right. But John, you mentioned something that made me, I think, somewhat validates a thought that I had about that qualification process. Like when I purchased my car last year, there was no request to verify income. But I wonder if a lot of times that's because they can look like they have those internal metrics that look at your credit report and they can go, based on what he's buying and what he's paying every month and what he claims he makes, he probably does. Is that more or less how these things work?
100%. I've financed 2 cars over the past 4 years. I put some number in there that I had made the prior year, and I'm self-employed. And you know how hard it is for self-employed people to get loans. They treat us very differently than else was given. Um, and neither time was I questioned at all about the income. I spent more time convincing them that I was really John Ulzheimer because I have fraud alerts on my credit report.
Right.
And that my income, which was kind of a guess, because I'm like a lot of self-employed people. One month I make this much, and the next month I make that much, and the next month I make this much. So it really it flexes over time. So I just use what I made the prior year and call that my income.
Right. Okay. David, answering the question I asked, did that help him? He said, yes, it does. Thanks. Very good. And we got a couple more questions, but let's continue over to, let's give a check mark under capacity. And then, John, why don't we talk about usability for debit card versus credit card?
Yeah, so that's the one we just did with the whole hotel and the rent-a-car, the usability issue. I think we were on the last one, which was...
Yep. Control.
Yeah.
I'm getting ahead of myself.
No, this is, I think most people know, this is the one that the debit card is going to win. When it comes to budgeting and self-control, I cannot tell you, David, how many times over the past 30 years I've been asked, how many credit cards should I have? And my answer is the same as however many you want. There's no law that says you can have 10 credit cards or you can't have 4 credit cards. You can have as many as you want. You're a grown-up. You can make your own decisions. And what I really would like to say, but this is kind of a smart mouth answer, is to some of the people who asked me the question, the answer is none, because you're irresponsible. And, you carry gigantic balances month over month. You're paying 21% APR, which is the most expensive debt you're going to serve. And you complain about how much you're paying in interest, and you don't need a credit card. You don't use them right. So you need a debit card. So there are some people who have control issues. That they think the credit card is like a supplement to their income, or that they have to spend this amount of money because their peers are spending that amount of money, or they see what my son calls it, flexing. I don't know what that means, but I think that's when you're showing off online to your buddies.
I think that's about right.
Okay. That's from my 14-year-old, by the way, not from the 53-year-old. So there's certain folks who are irresponsible and probably shouldn't be using credit cards. And so the alternative, obviously, is a debit card, because they have built-in budgetary controls, because you can only spend the amount that is in your checking account or an amount very close to that. Where a credit card, you could spend the whole darn thing overnight.
Very easily, yeah.
With a debit card, you do have that built-in budgetary control. So yes, debit cards are definitely better for some folks than others. And prepaid debit is better for some folks than even debit or credit. So if you have, like, sending a kid off to school and they need some sort of method of paying, you can either add them as an authorized user on an existing credit card account. If you don't like that idea, debit card is obviously an option. If you don't like that idea, then prepaid debit is another option. So there's a lot of different ways that you can empower people to, give them the capacity to buy stuff using plastic. And it may have their pros and they all have their cons.
Excellent. Okay. Question from David Williams. In your opinion, I'm assuming that is the credit industry moving forward, or moving more towards automated approvals as opposed to a actual human approval? That's done now, isn't it?
We moved there about 30 years ago. That's actually why the industry essentially moved at lightning speed off of a non-credit scoring environment pre-1989 to today, which there are 25 plus billion scores calculated annually, and that's like 4 times the global population. And that number is only in the U.S. We are clearly there. There is no human being that makes a decision any longer. Even though you may talk to a mortgage broker, or you may talk to the F&I manager at an auto dealership, or you may talk to a teller at your local bank or credit union, most credit decisions have been predetermined by somebody you're never going to meet in a state you're never going to visit. And whenever you make an application, as long as that number is above some other requirement, then you're going to get a yes. And if it's below some requirement, you're going to get a no and an adverse action letter in the mail a few days later. So the days of printing off a 20 or 30 page credit report and sitting there and flipping through it and trying to decide whether or not this person's going to be approved, those days are long gone. And now that information is scored and processed through automated underwriting systems, and the decision has already been programmed in by the risk assessment and marketing people. And so that stuff is all automatic, which is why you can get. So my father, who's in his 80s, always used to tell me a story about his first interest rate on a mortgage loan was like 21%, which is a joke. Yeah. No one watching this has ever paid 21% on a mortgage loan. But that was rate on an auto loan, back in the dark ages. And he said it took him like 4 months to get approved. And no, that doesn't happen today any longer, right? I mean, interest rates on mortgages are sub 3 if you've got good credit, and you can get pre-qualified in like 5 minutes. So that's the benefit of using these automated processes versus having to send it to some other person to ask another person about their opinion and blah, blah. And then you get inconsistencies and bias. So it's the current system, while people love to complain about it, I always remind them about my dad and his 21% interest rate 4 months later on a mortgage loan, and they seem to like, ooh, God, that'd be even worse.
Yeah. Well, also, David, too, going back to a past life, 20 years ago, I used to be an F&I manager in GM for Saturn, and it was all, even back then, it was all automatic underwriting. You just put in the application, all the information, and it was an approval from either GMAC when they were still around. I think they've changed to something else now. What's that?
I think maybe Ally.
I think you're right. I think it is Ally. Or it would be some other, subprime lender. So it's been around for quite some time.
The mortgage broker and the F&I manager has been, what they're doing now is they're deploying policy. That's really what they're doing.
Yeah.
Because and FHA and VA and USDA, the policies are deployed by them. And it's really the mortgage broker who has to follow those particular policies, which is the same as the F&I manager. You have the captive auto lender, and then you have multiple other indirect lending partners that the dealer has. And so the F&I manager doesn't say, FICO 760, that's an approval. The F&I manager says FICO 760, that's an approval here, because that's what my indirect lending sources are telling me. So really, they're doing nothing more than deploying policy than making an actual decision.
Yeah, we were pretty much just button pushers back, even going back 20 years. Question from Melissa. Thanks. Also, what kind of FICO scores are needed for the mega banks who issue higher credit limits, 750 plus, or realize other factors like current utilization come into play?
Yeah, so it depends on the issuer. So Amex, for example, doesn't have a subprime product or credit card product. They've got the Bluebird, which is prepaid debit. But Amex, if you've got 580, you don't even need to apply because they don't have a product for you. Credit One Bank, Cap One, they do. So it just depends on what kind of quality credit you've got it. So if you've got those really stratospheric scores, then yes, you're more likely to get those higher limits if you are combining that with an income that justifies that higher limit. And yes, certainly if you've got tons of credit cards with balances already and you're heavily utilized, you may not have the capacity to take on another high limit card unless it's a card and you agree to transfer balances off of a bunch of other cards onto the newly opened card with that 0% grace period for some period of time. And I love that as a strategy if you're disciplined enough to use it to get yourself out of debt rather than just to kind of bide time before you have to get another similar card.
Yeah. Good question, Melissa. Daniel up next. Hey guys, I filed for bankruptcy a year and a half ago. It's been discharged. I'm working my way back up. I started sending out my letters. Any suggestions on how I can build my credit rapidly. John, you and I have had this conversation a couple times, how much easier it is to rebuild after you file bankruptcy.
Yeah, so I assume the letters, David. I'll let you address the letters part of
I
the
don't think there's a
question.
question about the letter. I think he's just saying that he's in credit Versio. He's got his letters out, so that's a completely separate subject from the question he's asking, which is, what do I do now?
Yeah, so I mean, look, if it's discharged already, then it was probably a Chapter 7, which means it's going to be 10 years from the filing date. But you're also out of debt, which is really nice. So,
Yep.
you know, I try to be very realistic with this question, because I don't want to insinuate that this can happen really quickly, because that's not the correct answer. I think you have to be reasonable with your expectations. It's going to take a decade for you to get your scores as high as you want them, because there are certain levels of scores that you simply can't have with a filing on your credit report, and it's going to be 10 years before that thing is gone. Having said that, you don't need an 850 to qualify for stuff, right? I mean, you need a 720 to get the best deal on an auto loan. You need a 760 to get the best deal on a mortgage. So really, it's a matter of kind of resetting your expectations and resetting your target score to not be 850 and to be 780 maybe, which is a whole lot easier to hit than 850. So there's a couple things to keep in mind. Is that a lot of the debts that you've discharged, I assume, were unsecured, which are going to be your credit card debts. Those are eventually going to fall off your credit reports, which is fine, but you're also going to lose the value of the age of the account when it's gone. So really, it's almost like swimming against the tide to some extent, because you take one step forward with the deletion, but you take a step backwards with the loss of the value of the age of the account. And that also is problematic, because I know some people are like, oh, get this secured card and get this jeweler's club card, blah, blah, blah. And I think where they're just trying to populate their credit report with stuff that isn't bad, but they're also populating their credit report with stuff that's brand new, which drags down the average. I mean, that's mathematical certainty, right? If you add new stuff, you're going to drag down your average. That's a problem, right? Because credit scores like to see older credit reports. So I answer the question this way with almost a non-answer, because I don't want to insinuate that if you do what John said, then I'm going to have a really good credit score in the next 12 months, because that may not necessarily be the case. What I would do what I would suggest is that you reset your expectations and look out 24 to 48 months as your horizon. And the reason 24 to 48 is because you would be surprised how many points you're going to earn back organically, simply because you're putting time between yourself and your bankruptcy. 12 months, then 24 months, then 36 months, then 48 months. And you're going to see your score go up by doing absolutely nothing except for letting that stuff age. Now, it's not going to shoot through the roof, but it's certainly going to start going in a positive direction, unless you keep doing putting negative information on your credit report, and then you're never going to have a higher credit score. So, reset your expectation, 24 to 48 month horizon. And to the extent that you can get new stuff, that's fine and great, because I know we all want credit cards and it's important to be able to function with them. I mean, hell, I just spent the last hour telling you how they're so much better than everything else. But I also want to set the expectation properly that opening a bunch of new accounts isn't necessarily always what it's cracked up to be.
Excellent. Daniel, hope that helped. Pascale, I hope I'm saying that right. Will this be recorded? Yeah, it's being recorded, and as soon as we're done, actually, it's being recorded and is posted on both YouTube and Facebook. So as soon as we're done, the video is going to be there. And apparently, John, it looks looking at a recording of this must have a very live feel. There was a guy last night that completely blew up the comment section. I think he had like 9 posts. And finally, this last one in all caps was, "Why are you not answering my question?"
Did you finally like, dude, this was posted like 3 weeks ago?
Yeah, well, as a matter of fact, it was about 5 weeks ago. I'm like, dude, look at the date at the top. I'm happy to answer your question, but let's just bring it down a notch. Okay, Rick Phillips with just a comment. I have 1 home loan, 1 car payment, 1 credit card. My scores are all in the 700s. I'm good. Yes, you are. Well done.
Well done, my friend.
Okay. And David Williams, cool, thank you. That was from the question that you answered a few minutes ago. Okay, and we are coming up on 50 minutes. Wow, that flew by, John. That was a really, maybe it's because you're so well lit. You got the beach in the background. It's just an overall great day. The time just flew. Okay, that's it for us. Looks like we got the last question. Everybody, thank you so much for joining John and me today. I appreciate it, and we will be live again. John will be kind of mid-month next month. And then if you guys have any questions, if you're watching this video recorded, please don't blow up the comment section with 10 comments asking why we're not getting to it. Just leave one question, and I will be sure to answer your question. Thank you so much for joining me. John, thanks again so much for being here, and we will see you next time.
Thanks, y'all.